Welcome to Upthinking Finance, a podcast that offers a unique and discerning view of economics and financial planning. Here is your host, Emerson Fersch.
Welcome to another episode of Upthinking Finance. Ray Dalio once said, "He who lives by the crystal ball will eat shattered glass." So I want to thank everybody again for another great year following the podcast. Thank you for your support. This is the last episode for 2024, and I thought it'd be a great idea to bring on an economist and discuss with her the macro factors she's following as we head into 2025. Her name is Lyn Alden. She's an independent analyst that publishes monthly research reports through her firm, Lyn Alden-Investment Strategy, which she founded in 2016. She has a bachelor's degree in electrical engineering and a master's degree in engineering management with a focus on engineering economics, engineering systems, and financial modeling. Her goal is to provide institutional level research in plain English so that both institutional and retail investors can benefit from it. And as a client of hers, I can tell you she hits the mark with everything she publishes. Additionally, she serves as an independent director on the board of Swan.com and is a general partner at the venture capital firm Ego Death Capital. She's the author of the 2023 best-selling book, Broken Money, which is about the past, present, and future of money through the lens of technology. So it's my pleasure to welcome, coming to us from Cairo, Egypt, Lyn Alden. Lyn, welcome to Upthinking Finance.
Happy to be here. Thanks for having me.
Thank you. So I think the first question I need to ask you is how you found your way into providing investment research, because your background certainly is pretty diverse and it doesn't follow the usual pedigree, if you will, of, an MBA here and economics degrees there. So I think it'd be interesting just for people to understand a little bit about your background.
Sure. So I kind of had two simultaneous paths of interest. So when I was young, before I went to college, I was into investing. I was like the weird kid that would read the Wall Street Journal or watch the finance section of the news. Started investing in precious metals and then in equities by the time I was a teenager. So that was like one path that I was very interested in from a young age. When it came time to go to university, I decided to go into engineering instead of finance. That was kind of my other area, as anything math or technology related. And so I ended up going into electrical engineering. And then when I graduated, I went into engineering work. But I quickly kind of found out that, I don't have a long-term interest in being like a pure engineer, like someone is a design engineer for their entire career. There are people that love that. And I found that I wanted to have a broader view of what I work on. And so I kind of realized pretty early that I wanted to blend a business and engineering background. And so I was a design engineer for several years, and then I shifted more toward management, engineering management. And I got a degree in like a master's degree in engineering management. It included financial modeling, discounted cash flow analysis. The funny thing is I had already been studying that anyway. And I eventually became kind of the manager of that facility, running the finances of the place, running the contracts that we did, the procurement, all those sorts of things, kind of that blend of finance and tech. And along the way, I'd also been doing investment research on the side. So back in 2010, I started an investing blog. I would just kind of talk about personal finance or equities and would just kind of research things, put it out there. It was like a little hobby I had on the side. I eventually sold that after a number of years to a larger publisher, took a break, and then 2016, I decided to kind of start a more serious project. That's the current website I have, lynalden.com. And again, I put personal finance there, but instead of just focusing on equities, I focused on macro, I focused on equities, I focused on a broad variety of different investment areas. And that eventually blew up so big that I was basically forced to leave my engineering/management job to focus on that full time. And I think there's an industry trend where, newsletters have been around for a while, financial newsletters. They have a kind of a reputation of being somewhat sensationalist, kind of the long-term reputation that they have. Obviously, there's good ones, there's bad ones, but that's kind of, anyone can make a newsletter, so the barrier of entry is pretty low, and that's why they've historically not had the best reputation. But I think that, in the current era, a lot of institutions are finding that instead of having a full-time analyst for all these different areas, they can go out and find, an analyst that specializes in a certain thing, and then they basically buy part of their time with a subscription package, maybe an institutional one. And so there has been this kind of emergence of more serious analysis, and I think that's healthy for the industry, where a smaller institution, a smaller fund can piece together the research they need without having a full-time person for every area. I certainly benefit a lot from other people's public research. and I put out there what I kind of view as institutional type of research, but in plain language, so that I have a pretty broad audience of retail to all the way to institutional and everything in between. And there's been a good niche for that. And the way that I kind of bring in my engineering background, sometimes it comes in when I analyze energy systems or certain tech, but more broadly, it's how I use a systems engineering approach to analyze macroeconomics. So mostly what I did as a design engineer and then as an engineering manager was systems engineering. So it's kind of the art and science of designing, analyzing, maintaining a system that has like a ton of inputs and a ton of outputs and complex governing logic, figuring out what happens if this input happens and changes. And I basically take that same framework when I analyze macroeconomic systems, because ultimately these are human designed systems, just instead of photons and electrons floating around, they're financial plumbing.
You actually touched on something that has been a bit of an evolution on my side of the desk, so to speak, as an advisor to clients. And that is, you're right about newsletters. And I had a bit of an awakening over the last 5 years. And one of the things I realized was, the free information that you're getting from these product, these vendors, these big firms, all has a product solution to it. It's always geared to steer people the same way. And it's all the same. And I hate to say it, but there's an element of a narrative. And one of the things I've really appreciated, as far as our firm has done, as well as just your background, because we have I met you through, as you know, Mike Philbrick over at Resolve, and they're part of a fund family, Rational, which is connected to another company or firm that we do business with. But there's a uniqueness to some of these money management firms, and that is that their background isn't the traditional path. One company that we place money with has a NASA engineer on as a consultant. Another one has a bunch of contract attorneys. I appreciate the fact that even my business partner, Amy, I mean, she has she graduated with some kind of honors in dance, yet you can find this overlap. There's these patterns, which you can speak to better than me, but it's like you said, you can actually see things outside of a box and come to it from a different angle. And, as you know, I'm a recently new client to you, just because I wasn't familiar with your work, until I watched an interview you did with Mike. But I really appreciate your work because there's a logic to it. There's a flow, and it's very unbiased, which that in and of itself can be very difficult to find. You lay it out and leave it to the reader to kind of figure out how that's going to apply to, what we're doing. So I appreciate it. And so you're a nice compliment to some of these other, as you said, niche providers, because, it never occurred to me in years past to pay for research. But you it's the whole thing, you get what you pay for. So anyway, I just appreciate the fact that you're a contributor to the work we're doing with our small firm. So let me reference your newsletter from the end of October, or where you talked about, or there was a post about these 4 macro catalysts that you were looking at going into 2025. And now that the election's over, that certainly may change or at least solidify some views that you may have had before. But I think it would be great for the listeners of this show, just to maybe get some of your thoughts on those. The first one was the election. Now that Trump's in, I mean, you kind of mentioned in your write-up that, there's always the promises in the campaign and then there's reality. And so how does kind of all that shake out for you?
Yeah, it's a good question. I think that investors on average, I think, overweight politics in their investment analysis, that they think that elections are going to have a bigger impact on their investments than in practice. But I think that this election, there's a bigger variance than there normally is, right? So, for example, when it was Obama versus Romney, obviously the outcomes are going to diverge somewhat based on who wins, but there's still a pretty tight window that you can expect. This particular administration, there's a bigger variance, I think, for what can happen. Whether you look at it from a proponent or detractor standpoint, the proponents think there's tons of upside potential, the detractors think there's tons of downside potential, probably a bit of both in reality, because there's probably going to be some non-traditional economic things or things that have not been common in the United States, things like major tariffs or things like that could be kind of new things for investors to navigate. So I think the starting point is, again, whether it's positive or negative, just kind of realizing that the bounds of outcomes here are probably bigger than the average 4-year assessment period. So this is one of the rare cases where I probably wouldn't downweight politics as much as I normally do in my investment analysis, because there's things you have to wait and see. Things like major tariffs. The hard part there of like analyzing that is that the president-elect has said he intends to use them as a negotiation tool. So instead of saying, okay, these are the tariffs that are going to be imposed, it's okay, we're going to have a president that's going to use tariffs as a negotiation tool. But how do you forecast what the outcome is actually going to be, the quality or the outcome of those negotiations, what tariffs actually land, how much they're looking for a given to not do tariffs, what would the self-hitting aspects of the tariffs be? Like it impacts other countries, but also impacts the United States. The other factors, things like obviously it's a very hot topic, is immigration. Adding or subtracting labor can have labor dynamic effects, inflation, deflation, all sorts of things like that. Impacts on wages, depending on where you stand. Like if you're a corporation, you probably want lower wages. If you're a worker, you want higher wages and less competition. So these are dynamics that are going to be impactful. I'm also watching the Department of Government Efficiency that's being proposed. It's not an actual department, but it's an advisory council. Elon and others to ostensibly cut government deficits. I did an analysis of that in one of my recent reports, showing that a lot of the spending is not really tied to personnel, although there is some personnel spending. Obviously, there's millions of people, but the biggest chunks of spending are more in the transfer payments category. So things like Social Security, Medicare, interest expense, veterans benefits, all those types of areas. They're much harder to trim than just headcount. If some of the two biggest areas are Social Security and Medicare, and if you add up the personnel, it's negligible. They're a tiny percentage of personnel in the government, even though they're responsible for a massive amount of spending, because most of that is in the form of transfer payments that are challenging to cut. One of the biggest wild cards is probably Department of Defense. They want to cut that. There's certainly a lot of ripe area to cut there. The politics of that are such that every representative that has a base or a manufacturing facility in their own jurisdiction is going to push back on any sort of thing that would impact their own citizens' employment in their jurisdiction. That's a challenging Gordian knot to tackle. So I tend to take the under on how much that's going to effectively cut, although I plan to watch it pretty thoroughly, because the size of the fiscal deficits are a pretty big part of my investment thesis. So some of the other aspects of politics I don't really touch, but the fiscal aspects are certainly a key aspect that I monitor. So that's one of the biggest things I monitor. I also, in that newsletter piece, I talked about the potential for a debt ceiling issue and the associated liquidity effects of that debt ceiling issue. So historically, there's somewhat counterintuitive effects of a debt ceiling. When the debt ceiling gets put back in place because some prior agreement has expired, which is going to happen here in January. The ironic thing is that for a while, it's actually good for liquidity, for not a great reason. Basically, that they're stuck, they're not able to issue net new debt, but they're still running deficits. But the government maintains a cash balance at the Fed called the Treasury General Account. And so what they do is they start spending that down back into the economy. And during the multi-month process that's happening, that's actually good for liquidity, ironically, until they basically, either run out and default, which hasn't happened, or until they come to an agreement at the 11th hour and then start refilling that cash account, which is generally negative for liquidity. So I was monitoring that there's probably a higher chance of a debt ceiling cash drain if you get a Harris victory, because historically the Republicans have used that tool against Democrats administrations more than the other way around, at least given the decade and a half sample size we have of that tool being used for that purpose. So I think that the Trump win reduces the probability pretty significantly of that debt ceiling being a material issue, and therefore removes that kind of liquidity tailwind that might have otherwise happened, ironically, in the first 6 months of next year. So those are some of my initial thoughts about the election. But then obviously we have 4 years to monitor some of these policies. And I'll be kind of monitoring things on a policy by policy basis, any sort of legislative outcomes and things like that, geopolitical agreements or outcomes.
And I'm guessing too, I mean, you didn't mention this, but maybe it doesn't need to be said, that when you get a lot of non-traditional, I don't know what the word is, mainstream leader types being put into these cabinet positions. I mean, RFK Jr. is the perfect one. I mean, at first blush, and I think I read somewhere after that nomination, pharma stocks dropped it to 15-year lows. I mean, those are the kind of variables, I think, from what I'm hearing, that it's not business as usual anymore, which makes forecasting all the more challenging. I mean, is that a fair statement?
Yeah, I think so. Especially, in his case, that's a specific sector. Other things that pertain to the deficit as a whole can impact almost every sector. This is kind of offset partially by the fact that the Republican Party does have a platform for 2024. So we can see like a list of expectations that they lay out. And for example, I believe from memory, Promise 14 in the 2024 Republican platform was not to cut Social Security or Medicare, and not to raise the retirement age, which is very different than the Republican politics of the 2010s, the Paul Ryan era, which was that those programs were kind of priorities to trim. And so the Democrat position was don't cut them. The Republican side was we need to trim and trim these. And now, at least in that specific area, the Republican side is kind of like how the Democrats were in years prior. And obviously the Democrats don't want to cut those either. There's kind of this like locked in spending that I think is pretty much baseline regardless of the election outcome that we now have. But then the specifics are things like tariffs, immigration or deportation policies. And then for specific sectors, like in terms of either food companies or healthcare companies, obviously, the Health and Human Services Department, it could be quite impactful. I think it's then partially slowed down by things like lobbyists. Kind of again, there's like in any administration, there's a gap between desires and then what is actually happening when all the real politics comes into play. I mean, in the initial Trump administration, he said he was going to eliminate the national debt, and then we added $8 trillion to the national debt. I think pretty much regardless of who you get, you're going to add to the national debt. And so I think there's obviously, but there is a bigger than normal variance here because of some of these picks that are different than picks we've seen in, say, the last 3, 4, 5, 6 administrations.
Okay, so I've got to ask you a question. You brought it up that I ask, and people have heard me say this too many times about over the years. I don't know if I mentioned when I first connected with you, but I've been advising clients, working with clients I've been licensed since 92. And, over the years, the questions always come up, what about the debt? What about the debt? And now that we're at, I don't even, 35, 36 trillion, I think, or whatever, and with $1 trillion every quarter, I got to ask you, I mean, I won't ask you where you think it goes because I unless you have an answer, but I think the question is as an investor, I mean, how do you view that? Because sometimes it feels like the big elephant in the room that, I mean, does it pop, or is it just this thing that's just a part of how we operate, the economy? So any thoughts, Lyn, you can share on that? I think, I'll know that I've made this interview a success.
The fiscal deficit has been a core part of my investment thesis since at least 2019. And that's when I viewed that the US was entering fiscal dominance, which is to say that fiscal deficits becoming an increasingly large part of economic analysis and investment outcomes. And that's for a couple of reasons. One is that the baby boomers entered their kind of retirement years. And so the entitlement systems kind of hit an inflection point where they became more top heavy. And so they added to the structural deficit in that sense. And then two, we've had 4 decades of rising debt, but falling interest rates. And so if you double your debt, but you cut your interest rates in half, you maintain your interest expense pretty manageably. And now, when interest rates bounce off zero and then even went up, but let's say they just trend sideways for the foreseeable future, you no longer have that offset. So you're getting higher and higher debts, but you're not offsetting that with lower interest expense anymore. And so you start to get something more akin to a slow motion fiscal spiral. And so I've been of the view that the large deficits, I wrote about this back in 2019, 2020, 2021, that they would be inflationary. They were. And now I've been more of the view that, okay, we're past that big weight, that spark of inflation, but now things are going to run hot on average more than people think, which is that, whenever there's kind of a borderline recession, I would err toward it's still running hotter than people think. So less deep recessions, less deflationary recessions, but on average, a little bit higher inflation. and a little bit more kind of dislocations, because if a person or an industry is on the right side of those deficits, if they're directly or indirectly receiving those deficits, they're probably doing pretty good. On the other hand, if they're not on the receiving side of those deficits, there's a better chance that they're struggling. And so the deficits have been a pretty big part of my analysis. The short answer is I expect this to go on for quite a while. I kind of view that nothing really stops this train for the next 5, 10 plus years. That this is going to go on for quite a while. Large background structural deficits, which then adds to nominal GDP, on average adds to inflation, but again, not evenly. So obviously technology makes things cheaper. Other things can make things cheaper, but on areas that are not offset by those, you can get pretty high inflation. You can get asset price inflation. You can get real estate inflation. You can get tariffs. We'll see what happens there as supply chains. We've had 40 years of globalization, which helped offset some of the inflationary effects of monetary expansion. Those are probably at least going to be slower going forward, let alone the potential for some of those reversing. And again, globalization has winners and losers, but generally the CPI is one of the winners, that it kind of reduces otherwise what CPI could be, because you're basically connecting Western capital with Eastern labor. When China opened up to the world and the whole Soviet bloc opened up to the world, this was a productivity boom globally. And that's kind of over, or at least, in terms of the magnitude, it's kind of over. It's kind of already done, and it has a potential for a reversal. So those are some things I monitor. To use the fact that I'm in Egypt right now, I mean, I come here every year. I have a second home here because I have family here. And last time I was here, they were dealing with 40% inflation. And life looked similar to how it looked when they had 10% inflation. People tolerate kind of background things. Like people in the US wonder what's going to happen when this kind of runs off a cliff. And my view is generally it takes on increasing emerging market characteristics. It doesn't just turn into Venezuela overnight. It's basically this background nominal deficit fueled, somewhat inflationary component that it adds to everything else we deal with. So in Egypt right now, over the past 12 months, there's been 30% broad money supply growth, which is extraordinarily high. Life is messy. It's going on. I mean, we're here. I'm having internet issues. There's power issues. There are challenges. Obviously, it's a developing country with a much lower per capita GDP. But the point is, like, a lot of things still function even when you have kind of crazy monetary outcomes in the background, unless you hit like the extremes, like the Zimbabwe's and Venezuela's and Lebanon situations. But I think the US is, especially because they're starting from a more developed capital base. We can also look at the fact that there's about $13 trillion of dollar-denominated debt in the world that's outside of the US. And it's not even owed to the US for the most part. It's like owed to other countries. Like, for example, a country in South America or Africa will owe dollars to China, for example, or Europe, or some entity in Europe. And this big intertwined euro dollar system and global capital dollar lending system, all that debt represents inflexible demand for dollars, which is actually currently bigger than the monetary base of how many base dollars exist. There's more inflexible demand for dollars than there are base dollars. So I think basically you get in the future a lot of money printing, a lot of monetary expansion to support the deficits. That does come with inflation, but it also does have a pretty long runway of demand for that currency. I like assets like gold and Bitcoin better than I like dollars in the long run, and equities and high quality real estate. But I think that kind of monetary inflation, partially fueled by fiscal deficits, is probably going to be something we're going to be talking about 5 years from now, 10 years from now.
That actually makes more sense to me than the sudden. The truth is always somewhere in the middle. And as much as I think people, as in this kind of a work, are drawn to extremes, it is what you said. It's like the what is it, the frog in the boy in the pot kind of a deal. I mean, it just, people sort of adapt and adjust. And you're right, that's good. So let me ask you this then. I wasn't even planning on it, but I mean, do you care to comment on the BRICS, where you are with all that? Because I know there's some that dismiss it as a bunch of countries that don't get along, and others, they control the greater preponderance of the GDP in the world. I mean, do you Can I ask you your thoughts just on the impact, if any, that whole alliance potentially could have?
Sure, I wrote about this in a pretty big article back in 2020. I also touched on it in my book Broken Money from 2023 and other articles. My general view is that that the global monetary system is going to become a little bit less unipolar. It's been quite unipolar ever since the post-World War II environment, first the Bretton Woods system, and then the petrodollar eurodollar system. Back when that was formed, the U.S. was over 40% of global GDP, and they had the biggest intact manufacturing base, they had the biggest military base, and every metric, it was very concentrated. As the world's recovered from that, and from an era of communism and colonialism and then wars and all that, we have a different world now. China has the biggest industrial base in the world, but they're behind in other categories. We have a little bit more of a multipolar world, in other words. And we've also had a hollowing out of the US in part because of the monetary system, which is to say that when the whole world uses dollars, the way that the US supplies those dollars is by running structural trade deficits for the most part. And that's kind of an automatic thing that happens. Basically, there's extra demand for dollars, which increases the strength of the dollar kind of artificially. So a lot of currencies kind of in the long run trade based on their trade balance, which is that if you run structural trade deficits for a long time, eventually you have a currency devaluation and kind of finds an equilibrium. But the US never really finds that equilibrium because we have this extra layer of demand for dollars and treasuries and equities and things like that, because it's the most recognized and most liquid ledger in the world. So when South Korea and Brazil, when those corporations make a contract, it's often in dollars instead of their own currencies. And I think that as the BRICS kind of face increasing frictions from that, as they become a larger share of global GDP, they want to naturally untether themselves from the dollar, at least partially. And in the US, we see things like, they want to reshore things, but that's hard to do with the system structured as it currently is. The part that I take seriously about the BRICS is the trade agreements and the kind of the bilateral currency trade agreements. So I do think that China is going to be increasingly successful at buying things in its own currencies and having some of its trade partners be willing to hold its bonds for short and intermediate periods of time, because they know that they can trade those bonds and currency units for a lot of goods that China makes. China is now the biggest trading partner for most countries in the world. The yuan goes a long way in terms of buying all sorts of goods and services. I mean, here in Egypt, you see Chinese cars on the road everywhere. Chinese automobiles have this big hockey stick. They're the biggest automobile exporter in the world now. They flipped Germany and South Korea and Japan as the biggest auto exporter, and all that happened in the past 3 or 4 years. Now they're in the early stages of making commercial airplanes. I think that'll probably go nowhere for a while and then probably ramp up some years later. There's a lot of things that the rest of the world can buy from China, and I do think that we're going to see, we've already seen obviously Russia kind of forced to partially de-dollarize and make more bilateral trade agreements with China. We see India and Russia doing it. We see China and Brazil doing it. I think that's going to continue. The part that I take the under on is any sort of unified BRICS currency. That's not really in any of their best interests. A lot of the BRICS countries don't even like each other. We already seen the issues of a monetary union without a fiscal union in Europe. They're more unified than the BRICS are, both geography and culture. It's even harder to do that from the BRICS standpoint. It's hard to have, in Europe, you can't really replicate the capital market depth of the US. So in the US, we have this one big liquid capital market. And when you have a shared currency or things like that, it's hard to have like a replicatable capital market of that size. And so one of the frictions you have with, say, the BRICS bilateral trade agreements is that they don't have this like big ubiquitous liquid capital market to put those surpluses into. So for example, during this whole multi-year saga to increase the usage of the BRICS currencies with each other, like Russia will run a surplus with India, for example, and then they'll have a lot of rupees, and then they say, well, what are we going to do with all these rupees? When a country has a lot of dollars, there's a whole bunch of things they can do with dollars. But when a country just keeps accumulating rupees, you could reinvest some of it back into the Indian capital markets, but they're just not that big and attractive compared to the US one. And so you get a little bit of a friction there. One of their solutions is, we see BRICS countries and other countries kind of accumulate gold a little bit around the margins on their central bank balance sheet. They put some of their surpluses there. So that's certainly an option that could continue. But I think that this is a slow motion, long run, friction filled way that still in the long run does somewhat decentralize the global financial system more than it is now. I think that they become more resistant to sanctions. They become less reliant on the dollar for international contracts, but not overnight and not without a lot of frictions along the way.
Hmm. Well, I tell you what, one thing that's clear, I need to spend some time reading the archives because clearly you've covered every topic that I'm going to bring up. So thank you for that. But it's funny, just a thought on China, because if they're the leading exporter, I don't even know that in the US we get, I mean, I don't think I've seen a Chinese car on the road. If I did, maybe I'm just not aware of it. So that's pretty impressive, right? I mean, there's actually some things you could infer just from that, because you'd think the US would be such a critical market. So that's interesting. There's two more things you covered. I don't want to, and I've got another question I need to ask you. I want to be respectful of your time, but you brought up as these other macro factors, the expiring tax cuts, and then bank lending, and maybe just touch on those two to the extent you want to.
Yeah, so one of the early stage things I recognize about the election, there's a lot of promises that both sides say they're going to do, but one of the kind of kind of the year one things is that by the end of 2025, the Trump era tax cuts of his prior administration are set to expire, at least some of them. So when they made the deal back in Trump's first term, they did a number of tax cuts, and the corporate ones were permanent, but like the household ones were temporary, that they have an expiration date where if they're not renewed, they go back to their prior levels. That was an outcome that was likely to materially differ depending on the election. And so because Trump won, it increases the odds that those are going to be renewed, especially given the way that Congress went as well. So those are if we got a Harris victory, there's more likely that at least the top tax brackets would probably revert to where they were before. And that's where the majority of the cuts were. So that actually would be a material impact to the deficit, which has all sorts of implications on investment outcomes. But because we got the Trump win, they're more likely to stay in place in some material capacity. So I think that's something to watch. We still have to see the actual legislative outcome there. But that's kind of the default view by most market observers, including myself at this point. There could be some divergent opinions on that. And then the bank lending thing I'm watching because, and this ties back to fiscal dominance. So if you look at like the senior loan officer surveys in banks, for example, whenever you see like a really big percentage of them say that they're tightening credit, especially when you get like over 40% of them saying that they're recently tightening credit, over the past 30 years, that's been associated with a recession. And so in 2022, and then extending into 2023, if you just looked at loan creation and senior loan officer surveys around tightening credit, if you just kind of put your blinders on and looked at those metrics, it looked like a recession. If you look at things like the misery index, which is the sum of unemployment and inflation, 2022 reached recessionary levels, and yet we didn't have a labor cycle recession. And the PMIs, we've had kind of a record amount of time with contracting purchasing managers indices. So PMIs below 50, normally that's been associated with recession. So we've had a number of these recessionary indicators, including bank lending, which historically has been very important for the credit cycle. And yet we've not officially had a recession. And, I've argued that a large portion of that is because we're in fiscal dominance now. So if you look over the past 70 years, and I've published these charts on this, historically, bank lending, like the annual amount of new bank loans created, is bigger than the annual deficits, usually. And the kind of the brief exceptions for that for most of the past 70 years were briefly during recessions, because you'd get a reduction in bank lending, you get an uptick in deficit spending, and there were these kind of brief, maybe 1 year windows where the deficit would be bigger than the amount of bank loan creation that year. But in recent years, we've had fiscal deficits exceeding bank lending, even in non-recession environments. Like you have multiple years in a row of just deficits are bigger now. Bank lending, even though it's really sluggish over the past couple of years, and credit availability has been pretty tight, especially for smaller businesses that are more reliant on bank loans and less reliant on capital markets for borrowing. That has been a pretty friction-filled area, but it's not been enough to slow down the economy too much because we have these large background fiscal deficits, which are kind of supporting parts of the economy. Even as simply as, Social Security is going out and then people are receiving it and spending it on things like travel. One of the things I'm kind of monitoring is that we are seeing signs that the credit cycle might have bottomed, that they're not really tightening at the rate that they were in 2022 and 2023. There's by no means any sort of credit boom happening, but sometimes reversals are the most important areas. So if credit availability goes from really bad to still not great but less bad, that's an inflection point. And so if you get these background structural deficits, but then we go back to a period where loan growth is slowly coming back and other things are kind of past those recession indicators, you could get a second wave of inflation, maybe not as bad as the one we already had, but you could get another wave of inflation. You could get another round of, nominal GDP coming in hotter than people think. And that's one of the kind of the Boolean outcomes that I'm watching to see to what extent have we seen kind of the worst part of the credit cycle that we could start getting an additive effect of deficits plus less negative bank lending, a neutral to positive bank lending. And I think that's one of the top 5 variables that I'll be watching in the coming 6 months, 12 months, and further out.
It's an exciting time to be doing this kind of work for sure, because it's not just looking at a couple of charts and making some conclusions. I mean, God, I'm exhausted just listening to all this. I'm sorry, but that's why we diversify. I got to ask you one last thing, and I know we're just about up against it, but I know you do a lot of work with crypto, and I wanted to just ask you this on the asset class as a whole, because I remember reading a white paper, I don't know, a couple of years ago about Bitcoin, whatever, and in the sort of the risk factors. One that was really prominent was the fact that it hasn't seemed to have demonstrated any correlation yet, and again, this was just an opinion, but that's why I'm asking, because, you have asked, and for anybody who doesn't know what that, I mean, it's, interest rates go up, bond prices drop. You have things that impact each other. Where interest rates go up, typically the currencies go up with it, depending upon, but that's a question. Is it really at this point more driven by geopolitics, or do you see from the work you do that there are correlations, if that's even the word? Maybe it's not in the traditional sense, but I'd really this is kind of a side question. I figured you're like the perfect person to ask. So maybe we can end on that.
Yeah, so it's a good question. I published a research report a couple months ago in collaboration with an analyst named Sam Callahan, because I've observed over the past several years that Bitcoin, the closest correlation I found with it is various measures of liquidity. That among asset classes I track, Bitcoin price tracks the measures of liquidity that I monitor closer than any of them. So Bitcoin's the number one that correlates with liquidity. Stocks and gold are kind of the second realm, and then other assets less so. And so one of the biggest predictors I've seen for whether Bitcoin's going to have a good 12 months or not is whether various measures of liquidity are rising or falling. Combination of bank lending, dollar index compared to other major currencies, because we're taking into account global liquidity here. It's a global asset. And so generally, whenever you have a combination of better credit creation and a weaker dollar, you get higher liquidity and generally pretty good Bitcoin pricing. Doesn't necessarily follow on a week by week basis, but on any given 12-month period directionally. And then there's kind of industry, more like asset specific things. So one, I view it as kind of it's a tech adoption curve with this liquidity overlay over it. So in most technologies, when people adopt a new technology, they don't de-adopt it. So when they get a smartphone, they don't go back to a flip phone ever. There's very low percentage that do that. So you have a smooth adoption curve. But because Bitcoin is an adoption, like a tech adoption, but it's also a unit of account. It's a thing with a price. So people can buy at the top and then get disillusioned and then sell it. So you actually do get de-adopters in every sort of cycle. And so you have this kind of like gradual tech adoption, but overlaid on top of that, you have this like liquidity sine wave and this price sine wave with booms and busts along the way. I generally view, I'm fairly negative on parts of the crypto space, which is some of the altcoin stuff, a lot of it's not as decentralized as it's marketed to be. There's been this kind of arbitrage of, in traditional venture capital, I'm a general partner at Ego Dev Capital. I do some traditional venture capital, but the outcomes of the venture capitalists are aligned with the company. So you invest in a company, your liquidity is locked up for 5, 7, 10 years. And the exits are either that that company is successful enough to go public or successful enough that another company wants to buy it. Whereas in kind of crypto VC, there's been this kind of not very healthy dynamic of VCs investing in these kind of token projects. They lock up capital for maybe 2 years, and then they start selling the tokens to retail before there's any sort of actual product there. I mean, technically it's a functioning network, but it's like a kind of a Ponzi fueled temporary thing, and then it kind of goes away. But then the people that initially invested in the tokens, they first they get out on top. So there's this kind of like these repeated ways of kind of malinvestment in the industry. The areas that I think tend to be very important are Bitcoin and stablecoins. Stablecoins are basically just new rails for Eurodollars. In Egypt here, I mean, I know a physician that goes to the black market and buys physical cash dollars and stores them in his apartment for savings because the Egyptian pound is increasing in supply at 30% a year, and he'd rather hold some dollars, right? So, and stablecoins are basically just another way for people around the world to access dollars. So not very popular in Egypt, but they are very popular in Nigeria. They're very popular in Argentina. They're very popular in, all sorts of countries in the world, especially countries that have high inflation, but also have fairly tech-savvy populations. Stable coins are just very useful in that sense. And then Bitcoin is, a fairly decentralized network with a finite unit of account, final settlement when you transfer the asset. I view it as a gradual adoption curve that's happening, and that for the most part is correlated with liquidity as well as other factors. The other kind of asset-specific thing that I monitor is even though it doesn't have earnings, Bitcoin does have kind of valuation metrics. So there are ways to do on-chain analysis and see, if you add up all the coins at the last price they moved, what is kind of the average on-chain cost basis of the network? And then you can look at the market cap, which is simply what is the current price multiplied by all coins. And during those really big bull markets, you get a really big dislocation. Generally speaking, that's negative for price over the next 12 months. You kind of have this like outlier. It's like basically if one house on a block sells and all the houses on that block get revalued at this higher selling price, but there's not necessarily the liquidity to actually, if multiple of those houses wanted to sell at those price. And you get a less extreme version of that with Bitcoin, which is that, just because you have a 6-month surge in price doesn't mean necessarily that's a sustainable thing for the next 2 years. And so in our liquidity analysis report, we found that one of the few ways that you have a poor price outcome despite positive liquidity is when you start from that very overvalued extreme. So when I look at Bitcoin, the network, I look at things like the technology, the decentralization, what's being built on top of it, as well as liquidity. And then also lastly, I check for those kind of extreme valuation moves, which we're not currently in now. We're kind of in the middle of the range right now. So we're not really in a bottom valuation like you were in 2022. We're not at an extreme valuation like you were in 2017. We're kind of in the middle of the road right now. But those are some of the factors that I monitor when I try to have some semblance of idea of what something like Bitcoin is likely to do over a 12, 18-month period.
Well, I'll tell you what, it's a good thing for me that there's people like you. For sure, to just to take the time, because it's not easy, doing this kind of research. Clearly, it's like you said in the beginning, it's a full-time commitment. So your information, your research is available at www.lynalden.com, Lyn with one N, for anybody who's listening and not watching. And any just last final thoughts before I let you go, Lyn?
This is certainly an environment that's heating up in terms of complexity. I would say that when I was analyzing things going through COVID and then the aftermath of COVID with the inflation and then obviously the outbreak of war, that was a very challenging macro environment. Then we had kind of 2 years, I would say, 2023 and 2024, of somewhat less extreme macro moves, where there's still things occurring like the 2023 regional bank crisis and other factors like that, but it kind of settled a little bit back down to normal. And I do think that the next 2 years, I'm kind of back on like locked in high alert, because like I said before, there's more variance, I think. Again, we have a little bit more of a dynamic political environment starting in 2025, and that provides more upside and downside opportunities, maybe more sector differences where one sector gets hammered and another sector gets highly supported based on some of these outcomes. So I think it's kind of certainly a moment to be locked in. If anyone got complacent over the past couple of years, I think this is a time to pay attention to some of the outlier events that could occur and not necessarily assume that what's been normal recently is just going to continue as is.
No, that's perfect. Lyn, I'm grateful I found your work. I really appreciate you making time for me today, this evening, for you, in Egypt. And I just want to thank you for joining me on Upthinking Finance. I appreciate your time.
Emerson Fersch is a registered representative with and securities offered through LPL Financial, member FINRA, SIPC. Advisor services offered through LPL Financial, a registered investment advisor and separate entity from Capital Investment Advisors. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The guest speakers and the companies they represent are not affiliated with or endorsed by LPL Financial or Capital Investment Advisors. Individual tax and legal matters should be discussed with your tax or legal expert. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.